So, Greg, I want to start things off with a soundbite from our Jim Cramer on Mad Money last night and see if you agree or disagree.
We know the Fed can't raise rates here. That would make them look like total idiots. But every time we get a hot survey or report and long-term interest rates go higher, there are plenty of people who say that stocks have gotten ahead of themselves. There are others who know only one thing. If rates are going higher, then we're headed for a burst of inflation that will send stocks lower.
So, Greg, Cramer's thesis, basically higher bond yields, that was a big reason for the sell-off. It followed that hotter than expected ISM read. Agree with that. With yields right now, at the benchmark at least, at 4.67, is that just going to continue to put pressure on equities?
I agree with that notion. I disagree with the notion that it's episodic, is what Jim seemed to suggest. When we look at the inflation read, Frank, you well know, many of us have been concerned over the last few months about what's just happening organically. We saw core go from 0 basis points in June, 10 in July, 20 in August, followed by 3 30-point reads, and possibly a 40 for December. We'll see shortly. And so both things pose a headwind for equities, the organic rise of rates fueled by deficit spending, fueled by less of an appetite in China, Japan, potentially others, but also the resurgence of inflation, particularly given some of the administration's stated policy objectives and what that may very well force the Fed to do.
All right. Part of that thesis from Cramer is that investors are counting on rate cuts going forward. I want to talk to you about the Fed. So this is an interesting idea that you have here. You're saying the Fed's on pace for what they call a Vlocker moment. Kind of explain that, because your idea here is running contrary to what Cramer just said. What is this Vlocker moment that you think is coming up?
Yeah. So it harkens back to Paul Volcker in 1979, 80, and 81. And there, too, they declared a premature victory against inflation. And he had to come back in 1981 and raise rates almost to 20%, far higher than he had to do the first time. And so while I don't want to necessarily be alarmist and ring the bell on something of that nature, I do believe the evidence is being put in that we probably, or most of us, some of us did not, but most of us probably declared a premature end to inflation and that battle was over. When all of the evidence, you mentioned the ISM data, the JOLTS data, likely the jobs data, the core CPI data over the last 5 months points to a resurgence in inflation. And again, that is without the inflationary poo-poo platter of policy that the administration has proposed.
First and foremost, thank you for the pronunciation correction. It's Volcker. Made a little mistake on my end. Poo-poo platter. That's a great reference right there, Greg. But I think I want to get to the point of your thesis. So you really do think that the Fed would possibly raise rates? As Cramer was just pointing out, I think it might have been something he said before that particular soundbite, but he said then the Fed would lose their credibility if they raise rates after starting a rate-cutting cycle. So do you see that as a real possibility going forward?
I do see it as plausible. And this is not about a choice, Frank. If any of us had a choice, we would prefer for rates to stay lower. We would prefer for the cutting program to continue. I think if it's to become a reality, the Fed simply won't have a choice. When we start to get into mass deportation, trade wars and tariffs, deficits, cuts on taxes, I think you're going to see a very acute tailwind to inflation, and the Fed simply won't have a choice. You've already seen two governors, Bowman and Hackman, come out and say that they dissent from even last month's cut. So, I think at the very least, we're going to see a pause. I'm going to refrain from saying that it's likely that we see a raise, because by the time that becomes evident, I think it will become accepted that the Fed simply has no choice.
All right. I want to ask you about a red-hot sector in the markets over the last couple of months. That's quantum computing stocks. I know you're not a tech analyst, but in general, we've seen big upside moves when it comes to those stocks. And then yesterday, some comments from NVIDIA CEO Jensen Huang leading the whole basket to kind of decline double digits. I want to ask you, when we see a hype cycle kind of potentially at least get burst, what does that do to market sentiment? What does that do to the market action in your mind? I think most people would agree we're kind of in a hype cycle right now around AI. Quantum computing was supposed to be the next big thing.
Right. And I don't know if we're in a hype cycle, right? Because in terms of AI, we've seen the companies putting up the earnings growth. We've seen, the 50% plus earnings growth. And so while some, look at the multiples and say they're stretched, if you're going to give me 30% plus earnings growth over the next 3 years consistently, then that's worth a richer multiple. And so I think Jensen's comments had the natural impact in that many thought that we would see the same type of earnings S curve, within the next 5 or 6 years, and that was worth waiting around for. Is that worth waiting around for if it's 20 years away? Probably not. There's probably better places to deploy capital. So even an institutional or long-term investor, depending on how much weight you put into those words, would say it's better to come back another day there.